Let's ask this to Kaustubh Belapurkar of Morningstar Investment Advisors. As I said, he joins us on the show. Very special guest. Kaustubh, thank you so much for taking the time out. Really good of you to join in on the mutual fund show. A lot of people tend to do this, right, Kaustubh? They say that mutual fund mein invest karna hai. I'll choose the regular mutual fund.
Sure.
For ATC, the investments, I will choose the other instruments like PPF, etc., and all of that. There's this whole myth about ELSS schemes giving lesser returns. Why is that the case?
So I think there are 2 points to it. So one is people have traditionally been used to other instruments. We all know that mutual funds become popular now the last 3-5 years. But your PPF, your insurance policies, people have been buying for decades. So really that mind change has still not come across when it comes to ELSS funds. People have seen the returns with the other, your large, small and mid-cap funds, and they're coming in. ELSS slowly, I think that's gaining traction, like you said, but there's still a long way to go. The other thing that happens is people do last-minute planning, and then sometimes they're not too sure. Markets have already run up, so maybe we want to look at safer options rather than equity funds. That's probably the other thing that comes in. Like you said, it's March end, and people are probably scampering in to put in money right now.
Yeah, I got the idea from our conversation that we were having.
Absolutely. So I think it's investor psyche, but it's definitely changing. The other thing that's important to highlight about ELS is the beauty is A, it's an equity investment you're making, and B, that it's only a 3-year lock-in. Now, I wouldn't recommend people to take out the money after 3 years, but if you do need that liquidity at some point, it's much better than a 7, 10, 15-year lock-in, vis-a-vis some of the other instruments that you can invest under the ATC and other options. So definitely it's a fairly compelling opportunity when it comes to investing in equity ELSS funds.
Important to make the distinction here and tell you about this as well. The lock-in bit that Kaustubh mentioned. If you put money into an ELSS scheme, no matter what your need, you can't take the money out before 3 years, right, Kaustubh?
Yes, that's right.
So in effect, if you want to park money into ELSS schemes, you only park money that you can afford to forget for 3 years.
Absolutely. I mean, that's and I would say that it instills some sort of discipline in investors because you're not looking into the markets have corrected, you want to get out. So I look at it as a disciplining factor, which is an additional positive for the ELSS scheme vis-a-vis even traditional equity schemes, which is a nice thing to have because you can't touch it, you just let it be. And data has actually shown that investors tend to forget about these funds because they can't get out of it, they don't track it that often. More often than not, they've actually made a ton of money by just staying invested for 7-10 years. They forgot about it and then see the value. And the example that you showed, they're then extremely happy with the schemes that they got into.
Yeah, and mine was illustrative. We'll actually get into actual examples from you.
Sure.
But one question, Kaustubh, and that is, you guys really understand mutual funds so well. People have some automatic tax-saving investments, right? So for the section that we're talking about, the employee provident fund, assuming you're a salaried person,
that's right,
that gets deducted out of your limit of 1,50,000. Assuming that there are people whose salaries are high enough that their EPF contribution takes care of the limit.
Sure.
Then, obviously, an ELSS scheme is not a good idea. Rather, invest in a normal mutual fund or a mutual fund on merit is probably a better option. Am I assuming correctly?
So largely yes, because you don't have that lock-in. If you already met your ATC requirements, that's a good idea. But there's one thing which people don't really look into, and what we really like about ELSS schemes is because managers know that investor is going to be locked in for 3 years. He has a lot more visibility on flows, the AUM that he's managing, and he can actually get into his high conviction ideas without having to maintain too much liquidity. Or he's got a view on liquidity, in terms of because he knows what money is going to possibly go out when. Investors have matured now. We're not seeing investors come, redeem in a couple of years, but definitely, it's a little bit of a leg up in that sense because if I'm a manager and I'm told that look you have X amount of crores that are not going to be pulled out for the next 3 years, I can get into some of those high conviction ideas and just buy and hold and stick on to it and not really worry about interim fluctuations of the market. So that's that little additional incentive of coming to an ELSS where they could get that additional alpha through just a pure buy and hold high conviction buys by the managers.
Do you make use of ELSS schemes?
Yes, I do.
You do for your personal investments. You do?
Absolutely.
Oh, okay, awesome. So that's one point of conviction, right? That if you're thinking of whether or not to invest in ELSS, a gentleman out here who understands mutual funds like the back of his hand does make use of ELSS schemes as well. Okay, now before we get to some of the recommendations, Kaustubh, let's try and make a distinction of why is it that you have chosen the names that you've chosen today. What's the methodology that you guys are using when you are rating these schemes?
Okay. So typically what we do is, this is a fairly intensive human resource intensive process where a team of analysts actually goes and tracks managers and their strategies. So we spend a lot of time doing research and understanding what the strategy is, and then we have like a face-to-face interview with managers to understand what is the team, the manager's strengths, the process which he's following in terms of building his portfolio, and there are other qualitative aspects like the pedigree of the asset manager. And then we also drill down into performance, but it's not just your point-to-point performance. We actually try to understand things like performance attribution. And when I say performance attribution, it's about how broad-based is the returns that is he delivering. Is it kind of concentrated across a couple of stocks and sectors, or is it more broad-based across sectors and stocks because that's more repeatable performance from our perspective. And the last one is more of an expense ratio pillar, which is kind of a hygiene factor that we don't want very expensive funds, because that obviously automatically translates. It's not very, very important from an equity side right now, but from a fixed income side it becomes important, but from an ELSS perspective probably not as much. Given those constraints, we cover an X set of funds depending on where we see are the better managers or the larger strategies where there's more interest from investors. That's where we will put our qualitative ratings out. So we have ratings on about 9 ELSS schemes right now. And we talk about some of them, some for high-rated strategies.
Well, just before we get into that conversation, Kaustubh, do these ratings for these funds, or let's say the top 5 or the top 6, has there been a lot of churn in those names? Do the scheme's performance and thereby their rating in your parameters change considerably year after year, or are there names which have been constant as well?
The simple answer is no.
Okay.
We are firm believers of long-term investing, and I think to be fair to investors, if they're looking at our ratings and coming in, and we very frequently change it, that's an issue, because today if it's one of our best rated funds and he invests basis that and comes in 3 months, and 3 months down the line it's probably been downgraded a couple of notches, that's not fair to the investor, right? So because we're looking at that really deep dive into understanding the manager's philosophy, his process, the strengths of the team, how do they really construct portfolios, we don't think that it merits a rating change that frequently. We will keep reviewing his portfolio unless and until there are dramatic changes that happen in a strategy. So for instance, if he says he's a value sort of buy and hold manager, and suddenly we start seeing momentum, high growth stocks coming in, then yes, then we'll probably raise a red flag and say, okay, let's understand what's happening. Are you changing your strategy, or are you just not finding value so you want to drift away from your style? That's something we'll be conscious of. But otherwise, once we've assessed a manager, we do believe that it is for the long term, and that's really what investors also appreciate.
Okay, so let's talk about some of these names. We're starting off with, by the way, there are 9, as Kaustubh stated, there are 9 names or 9 schemes that they have within their recommendation list. 4 of them, if I'm not wrong, have a neutral rating, and therefore we are not taking them on the show today. We are talking about the other 5 wherein they have a preference, and those are the 5 schemes that we will be talking about. If you have questions about any of these schemes, please send in your questions. I'll try and get them answered from Kaustubh. Let's start off with the first one, Axis Long-Term Equity Fund. What is this scheme about? Why do you like it?
Sure. Okay, so before we actually just dive into each and every scheme, I just want to make that distinction that even within the ELSS category, right, there is a fair bit of style or market capitalization bias that you can have within managers. And I think that's important for investors to understand. So you might be getting into an ELSS, but because it is such a diverse category, you need to understand the underlying portfolio construct, what I was referring to, because a mid-cap based ELSS may not be suitable for all. But I would say most managers typically tend to drift towards a large cap sort of holding, but there are managers who do take sizable mid-cap holdings also. So you need to, as an investor, at least do that level of check to understand that, okay, is this strategy suitable for me or not when I'm doing my tax planning investments?
Based on your own risk profile?
Absolutely.
Okay.
Absolutely.
Will you be able to tell us which of these schemes fall within that bracket as well?
Absolutely.
Okay. So then let's start with Axis.
So Axis, Janesh Kopani, who's their CIO equities, he's been managing the strategy for almost 7 years now, and like I was talking about the style, so he's pure out and out sort of a growth manager.
Okay.
And his stated philosophy is that I'm going to look at supernormal growth, high growing companies, and I understand that they're going to come at a premium. I don't mind paying that premium price for it. So if you look at his overall sort of portfolio, stocks and PE tends to be higher than the rest of the peer group. So what you're going to see is a concentrated bunch of stocks. So typically runs about a 40-50 stock portfolio, and it'll be sort of a high growth portfolio that's coming in. He predominantly runs a large cap strategy, so you would see about 70% in large cap stocks. So from that sense, it's less risky or less volatile than a guy who would probably run 40-50% in a mid cap strategy. So that's really on his, and the fund's been doing like exceptionally well. It did have some blips through 2016 and 17, but now he's coming back up the curve, and I think he's been one of those really consistent performers. The other thing that we tend to look at funds, we try to see how a fund does in falling markets and rising markets, and Axis long-term equity, the beauty is that what we call the down capture ratio in Morningstar is basically how much of the down capture do you protect, or how much do you fall as opposed to the market. He actually falls 30% less than the market in bear markets, which is
despite he being a growth fund manager. Okay.
So I think it's a very interesting strategy and a very well managed and run strategy, and we have fairly high conviction on. The one caveat I would give that it is the largest fund in terms of size on this space. But we don't see that as a constraint because it's fair amount of money is going to large cap stocks where liquidity is not really a constraint. So that's definitely one of the top options that a manager that we like within this space.
Okay, so this is the silver category fund.
That's right.
Right? You silver is amongst your top category.
Yes, it's a second best rated.
Second best rated. Okay. The next one is a Franklin Tax Shield fund. You of course given it a bronze rating. Why do you like this scheme? Why the bronze rating?
Sure. So one, there's a lot of conviction on Franklin Templeton as a fund house. In fact, this strategy was being managed by their CIO Anand Radhakrishnan until a couple of years ago, till they hired a new manager in Lakshmikant Reddy, and he's really taken over. So Lakshmikant didn't really come from a mutual fund manager experience. He's come from ICICI Life, so more from an insurance. But he's worked in the markets for a very long time. He knows the ins and outs of research. And Templeton's equity team, in terms of the analysts, which is very important for us to understand, is one of the best and an outstanding team of analysts that's there to, deliver the stock ideas for the manager to really come in. So that's a starting point really for building the portfolio. Again, skewed towards large caps, safer in that sense, and it's a more diversified portfolio. So you'll see, he would be buying cross sectors and stocks, fair number of holdings. So his ideas, he doesn't want to get crazy out of whack top quartile returns all the time. He wants consistently sort of chipping away at, get into that sort of
the Rahul Dravid variety.
Pretty much. So it's that's really the philosophy at Templeton. I think that they've always been try to protect capital, be less volatile than the market, and so even if you look at the market betas of Axis or Templeton, they'll be actually below 1. And I'll maybe talk about some other funds which could be more aggressive and have higher market betas, but these are two guys who would definitely be much more conservative in their portfolio management.
Okay, so that's the second fund that we have. Third one is again a silver rated fund, HDFC Tax Saver. Now typically you would believe HDFC funds have a larger AUM. Why is it that you're choosing this? Because I did see you here or heard you say that in Axis's case as well, the equity AUM or the AUM in this fund is fairly high.
That's
so you
right.
don't see it as a concern. What about HDFC? Why do you like this fund and what are the characteristics?
Sure. So again, HDFC, I think a very strong fund house in terms of their research, and again, Prashant Jain, who's really been at the helm of affairs at HDFC, outstanding stock picker. Vinay Kulkarni, who's managing this fund, has been around with the team for a fairly long time, well ingrained in the HDFC philosophy. Again, given the research that he's delivered through the analyst team there, it is a fairly convincing sort of portfolio that he's built. I must give you that caveat that this fund has suffered, like the other HDFC fund suffered in 2015, where the performance took a major hit because they were early in the cycle, with some of the cap good companies and the likes of SBI, where they were probably the only people standing at that point of time on that counter, and it hurt them. I mean, it hurt Prashant's funds, hurt this fund, but they held on to their conviction because they knew that there is going to be a turnaround. And then we saw a lot of managers pile on to SBI later, and over the coming years, and they're still adding to that counter when we've seen that correction. So I think a great sort of team and a great manager who's really experienced, which is delivering the strategy. When I talk about the way the strategy is run, again, this used to have an element of mid cap, but now he's flexible. But right now, given the valuations, he's more comfortable being in large caps. So here's a manager who would switch between in large and mid, so more like a flexi cap fund manager. But right now, he's more in large caps just given the valuations. But this fund will tend to have a slightly higher market beta because the portfolio is geared towards the economic revival. So when you look at a sectoral exposure right now, financials is big, industrials, utilities are fairly large components of his portfolio. So you're going to see a fair bit of market beta. It could be volatile in the short term, but we think that if you're there for the long haul, this would probably be a nice fund to invest into.
Okay, so 2 silver-rated funds, which is Axis Long-Term Equity Fund and HDFC Tax Saver Fund. Now, the last 2 funds, both of them are bronze-rated, L&T Tax Saver and Reliance Tax Saver. Why do you like these?
Sure. So L&T, again, I think this is a fund house that's really come up the curve over the last. So to give you a background, Fidelity Assets, bought over by L&T, and Somendranath Lahiri, who's now the CIO, really took that mantle up in terms of, because people were worried that Fidelity had such great managers and strategies, would L&T be able to take that over nicely? And I think they've done that. So Larry and his team, while they're still a smaller team as compared to the rest of the street, but they've done a phenomenal job. The one thing that we've noticed is that they're amongst the few people who've actually taken some bets before the rest of the industry in terms of certain stock calls where they were probably invested a year or two before the other parts on the street recognize it. I don't know how they do it, but I think they have some super research analysts who are going there and finding those companies, unknown names to add into their portfolio, the multi-baggers of tomorrow. So while I say that, obviously this strategy is more of a multi-cap strategy. He will probably get 50-60% in large caps, the remaining is into small and mid caps. And he does do some value buying also in his portfolio. In
his tax saving fund as well.
Yes.
Okay, that's interesting. Lastly, a bit of a change out here in this fund house, but Reliance Tax Saver.
Yes.
Why do you like this, and should people view it differently now that maybe not the individual fund manager, but the guy at the helm is different?
Right. So yeah, like you rightly said, I mean, there's been a change. Obviously, Manish has come on, and Manish is another great manager who's spent so many years at ICICI. We really have him in high regard.
Yeah.
But Ashwini himself, who manages the strategy, has been with Reliance for a very long time.
Okay.
So we have that comfort, and we don't really see that as a change in terms of the way the fund's going to be managed. This fund is unique in that sense that it is a slightly more concentrated strategy. When I say concentrated, is that he will tend to look at 3-4 meaningful sectoral exposures in his portfolio, and the rest of the sectors will probably almost not exist. I mean, just one odd sort of names within that. So it is going to be sector heavy. So as you look at the performance, it's a fairly high market beta strategy. So it is going to be more aggressive. It's going to take on more small and mid cap exposures. So this might be for the slightly more risk loving investors, given that it's going to move up in the really good bull markets, but can fall, and like we've seen in 2018, the fund has fallen more than the indices at this point. So it is going to be that slightly more volatile fund, but again, through a market cycle, I think because we've seen that kind of strategy being run by Ashwini for a very long time, we have a fair bit of comfort that he should do a good job going forward too.
Okay, I have some questions, some
Sure.
tricky ones,
Okay.
some not so.
Sure.
Let's try and see if we can answer them.
Sure.
I'll completely understand if you can't answer the first one. Chinmay Kulkarni writes that he wants to invest in ELSS schemes, but he has not done KYC for mutual funds. Now, he was told that it will take at least 7 days for that to be done. Last 3 days of March are holidays. So will it be possible for him to invest into ELSS this year, or has he lost the opportunity this year?
Well,
Tricky
it seems,
one.
it seems like he has, because without a KYC, there's no way he can do it. There's an option of an eKYC if he's investing below 50,000 bucks, so he can explore that option through an Aadhaar linkage. But yeah, I mean, he'll have to explore that. I can't really guide him beyond that yet.
Yeah, it's slightly tricky, so maybe you don't have an answer here. Let me ask you about something that is more within your domain, Kaustubh. Ankit Shukla writes on Facebook saying that, what is your view on the DSP BlackRock tax saver? The monthly SIP is of 5,000 that he wants to maybe start or already has an SIP in. Do you have a view here on this fund?
So DSP is, I mean, again, a fairly good fund house. We do track this fund right now. We've kind of given it a neutral rating. There's been, I don't remember the manager's name right now, but I think it's Rohit Singhania, whom we had met some time ago. But a good manager, but since he was managing the infrastructure fund earlier, and he's just really taken on the responsibilities recently, we'd want to see some more time. But again, I think it's a good team. So we would say, probably hold on to the SIP. That it's not a bad fund to be in.
Okay, but Ankit, what Kaustubh is probably not saying, and let me try and say, they have given 5 funds which they have a higher rating on. So if you have an SIP, hold on. If you don't have, then, and if you believe Morningstar's analysis, then maybe you can choose one of the 5 funds that they have a bronze or a silver rating on. So I think that's the simple answer. Difficult to choose, but let me try. You can choose not to answer.
Sure.
Surendra Bhagat is asking, Axis long term or Reliance ELSS, which is best?
So I would say play it as per your risk profile. And we were talking about it. Axis is a more conservatively run strategy. So if you hate volatility, you probably want to get out in like 3 years. Axis might be a slightly better bet given that it's less volatile. Reliance, like I said, high beta. If the markets are in sort of a good bullish run, then Reliance could really hit it out of the ballpark. If you have the bandwidth, you could actually blend two, and that's the other thing that we love talking about. That the moment you blend two different styles of managers, that actually on a portfolio level smoothens out your volatility, and you actually get the benefits of both kinds of styles. So that's the other thing you could. So I know I'm kind of taking the in-between approach.
No, but this is great. Yeah, why choose only one?
Absolutely.
You can actually do a combination of both. I know we are going slightly over time, but there are a bunch of questions, so we'll try and answer some of those. I would request viewers that if your questions have not been answered because we're running slightly short of time, do send in the questions nevertheless. We'll request Kaustubh if he and his team can probably reply to those questions on social media during the course of the next 1 week, or maybe the next 2 or 3 days, because people would want to start their tax saving options as well. What about UTI fund? Somebody's asking. Do you have any thoughts here? Have you studied UTI tax saving?
So we don't have an opinion on the tax saving fund per se, but UTI. So they've obviously gone through a change at the top. Anup Bhaskar, who was their PIO for a very long time.
IDFC.
Vetri joined, slightly more than a year ago. Again, Vetri is a good guy, but he obviously needs some time to settle down. So I think the funds are stabilizing. Again, I would say it's hard to say that this one's the best, or but they're a good fund house. But I would give it some time before But I think Vetri is a good guy, so he'll definitely get that ship back up soon.
Okay, one last question, and then some of the other questions we'll take in on social media. But there's a question that has come in that the fund asset size, would it matter because IDFC and Motilal ELSS are low, but they have given very good returns? What would you say? Would fund sizes matter? So
that's a misnomer that comes in, that fund size can drive performance, maybe to a certain extent, but in a category like in ELSS where you're looking largely at sort of large cap strategies, fund size shouldn't matter because liquidity is not a concern. Unless obviously some of these guys who are running more mid cap heavy strategies, it's not the fund size that's driving it, it's the strategy that is driving it, which I spoke about, right? Because we all know how smaller mid cap stocks have run up in 2017. That's going to add a lot of returns to your portfolio if you were heavy on smaller mid cap stocks vis-a-vis a guy who had probably 70-80% in large cap. But it's important to make that distinction because this is a pretty diverse category. So you need to look at it, and that's why I urged investors that look at the underlying sort of portfolio holdings just to get a synopsis of how much large mid in the portfolio and take a call as per your holdings.
Okay, Kaustubh, one last question. Actually, I'm forced to take this because we committed to the gentleman. We'll ask is, he's asked about what does a switch mean in mutual funds, when should it be done, and is it applicable for all mutual funds? A quick 30-second view if you can.
Yeah, so switch is basically when you're switching between schemes, typically done within the same fund house, and you could even do it between a growth and a dividend option. So switch is when you're just switching out of that. So that depends on, do you really want to get out of an existing strategy and go on to a new one? That's a call that I would advisors can help you with.
I think it's very case specific, so you probably need to consult your advisor about when should you switch out or in within particular categories and within funds as well, different funds too. Please consult your financial advisor. For all of these advices, we really thank Kaustubh, but do consult your financial advisors before joining and giving us that perspective. Kaustubh, take a moment to thank you for joining in on the show. Really appreciate your time, and thanks for sharing some of these names with us.
My pleasure. Thanks.
That's the